Mortgage rates fell 2 weeks ago, then they climbed steadily again last week. Is it enough to motivate any new homebuyer activity, or are we looking at 2025 before home sales finally recover? From a total inventory perspective, we haven't seen any pickup in demand in the past couple of weeks as mortgage rates fell under 7%. To be honest, this is a bit surprising to me. I expected to be able to measure some pickup in demand with cheaper money. Two factors at play here. It could be that rates simply haven't fallen far enough or stayed there long enough. Like I was expecting that under 6.75% to 6.5% on the 30-year fixed would be a threshold where we'd see buyers start moving. We hit 6.5 10 days ago, but rates didn't stay there long and in fact climbed all last week. If I'm a home buyer, I'd have to be really attuned to rates and to my purchase options to jump that quickly. Most buyers are frankly not that aware. So rising rates can stop me quickly, but it takes longer maybe with lower rates to motivate me to action. So the other reason perhaps that we haven't measured any pickup in buyer demand with lower rates may be because of seasonal timing. So for falling rates to motivate buyers to take action, we'd need buyers actively shopping. And it could be that we're witnessing home buyers totally checked out for 2024, waiting to see where rates are, where the economy is doing, or who is president next spring. So if I'm a home buyer, I don't see a lot in the market trends now that make me want to jump right now. So whatever the reasons, we are not measuring any increase really for this dismal 2024 housing market. These are really fascinating developments. And are we past the opportunity for declining mortgage rates to help demand and pick up home sales for 2024? So to track all these variables in more depth, our August webinar is this week, Thursday, August 15th at 10 a.m. Pacific. That's an hour long where we get to look at all the detailed data and a little further into the fall market. So there's a link in the description below to register. Click that to reserve your spot. At Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the sales, all the changes in that data so that you can understand the U.S. housing market immediately as it happens. I'm Mike Simonsen. I'm the president of Altos Research, and let's take a look at the U.S. real estate market as of August 12th, 2024. There are now 693,000 single-family homes on the market. That is a 1.3% increase for the week, which is a little bigger increase than the week-by-week seasonal model estimated. So there are almost 41% more homes on the market now than a year ago at this time. So it was near the end of August last year when rising mortgage rates really slowed home buyers and inventory rose unseasonably fast. Last year, inventory was rising 1% to 2% per week through the end of October. So we have not hit the peak of inventory yet for this year. There's a 1.3% weekly gain in unsold homes on the market. And so that slope hasn't yet plateaued. From this supply perspective, we haven't seen any pickup in demand, right, in the past couple of weeks with mortgage rates under 7%. And as I mentioned, this is a bit surprising to me, and like I expected some pickup in demand with cheaper money. So in fact, we haven't seen even a plateau in inventory, and that implies to me that home buyers aren't really paying attention to the mortgage rate changes. So houses and payments are still very expensive, and it's late in the season. So the next signal we're looking for is whether the weekly inventory change levels off from 1.3% weekly gain to under 1% to flat week to week. So I'm looking for that over the next month or 6 weeks, especially if mortgage rates don't rise. If unsold inventory keeps rising despite dropping mortgage rates, that will cause me to go back to the forecast models and recalibrate. So keep your eyes on inventory for the next 6 weeks or so. Speaking of recalibrating, we did a big database upgrade this week, and some of the calcs are still being processed. So we're not publishing the new listings data this week. Well, everything will be back to normal on that front next week. So we're going to focus on the sales for the video today. So there are 367,000 single-family homes in contract with another 77,000 condos in contract. So that's 3% fewer pendings now than a week ago, and it's basically unchanged from last year at this time. When we look at the sales rates, it is totally normal for the pace of sales to decline in the second half of the year after peaking in June. In the first half of this year, I kept expecting that we'd get a little growth over 2023, but that ultimately hasn't materialized at all. And the pace of sales is aiming for just over 4 million for the year. That yearly number hasn't grown at all and is maybe even slipping from the pace earlier in the year. So in this chart, you can see how the dark line for 2024 is basically tracking at the same level as the red line from last year. Maybe in 2025, we'll finally see some home sales growth, but that is not in the data yet. Home prices. So sales are down and show no signs of improvement in 2024. Inventory is climbing and hasn't peaked yet for the year. So if supply is up and demand is down, doesn't that imply that prices would be falling? So you'd think so, but they're not. At least home prices on average across the country are not falling. In fact, a lot of markets do have home prices lower now than a year ago. Many places home prices are climbing over a year ago, but nationally home prices are up about 3% higher than a year ago. Looking at the price of the new listings cohort each week helps us see what's going on. So at the top of the chart, you have the lines from the last 3 years. You can see how home prices have barely moved since 2022. In the middle of this chart, you can see how home prices climbed so quickly during the pandemic from $300,000 median price to $350,000 to $400,000. So at the bottom of the chart in 2018, 2019, we had rising mortgage rates. We had like Trump trade wars that were really slowing the economy at the time. Home price growth stalled in 2019 into 2020. And then, of course, in Q1 2020, all the macro factors changed. So I like using this view of the newly listed cohort each week as a leading indicator of future sales prices. House gets listed now, it's on the market for a month, it takes an offer, it goes into contract, the sale closes another month out in the future. So when sellers have buyers at the price, they price their listing at a slight premium. And so we can see rapid responsive price changes. Currently, the median price of the new listings cohort this week is $410,000. That is down from last week and is just 2.8% higher than a year ago at this time. Sellers have what's known as downside stickiness to their asking prices. Home sellers don't really want to list less than what the neighbor listed for. So even in a light demand world, we don't see dramatic home price declines. And this helps us forecast what might happen over the next few years to home prices. We've had 2 full years with basically no home price appreciation, but not a crash in prices, even though we had a crash in total transaction volume. I could imagine a few more years with little or no change in home prices while incomes improve and maybe future mortgage rates fall again, so affordability finally recovers. When we look at the homes that are taking offers and going into contract this week, we can see the median price nationally is $389,900. That's down almost 1%, a little under 1% for the week, and is right around 4% greater than a year ago. So the new listings are showing 3% gains. The new sales contracts are showing about 4% gains. So the closed sales, the transaction prices for the year will be somewhere in this range. Sales prices inch down with the season in the second half of the year. And you can see this year's dark line is just a little bit elevated over last year when we look at the cohort of homes taking offers and going into contract each week. So people ask me how the Altos measure of home prices differs from other measures like the Case-Shiller Index. One difference is that Altos measures the housing market. Case-Shiller is what's known as a repeat sales index, and they try to look at the price of the same house over time. How much has the price of a given house changed? In the Altos data, it's if I walk into the market today, what can I buy? This is what I can buy. And this is the price that people are paying for homes. Altos is focused much more on how much do homes cost, where a repeat sales index is focused on how much has the value of a given house changed over time. So they're related, tightly related, of course. As demand increases, the market price climbs and the repeat sales value also climbs. But if you're buying or selling a house, I'd suggest that the number you care about is the market number. What's actually available today? How is that market changing? And is it affordable to me now? Even as the sales volumes haven't increased, as I mentioned, we're on pace to 4 million home sales for the year 2024. The buyers know where the price is. That $390,000 or so, that is the buy box of the American consumer today. And it's up just a tiny fraction from a year ago and showing no signs of dramatically increasing this year. It could fall quickly if mortgage rates jump again, or, for example, if the economy tanks hard. And we are approaching the end of the season, and the homes on the market now are actually priced at reasonably stable levels. So the percent of homes on the market with price reductions edged up this week. But the pace of price cuts is not really rising particularly quickly anymore. So about 39.7% of the homes on the market have taken a price cut from the original list price. That's up maybe 30 basis points from last week. And you can see in the next few weeks, the slope of this year's price cuts, the dark line, should take us below that dramatically slowing market of 2022. The price cuts data is consistent with the other supply and demand and pricing indicators we've been talking about today. None of it leads us to any price strength in the market, but none of it is collapsing either. And as I mentioned at the top of the video, I can imagine multiple years at this pace of pricing changes. I use 35% as a rule of thumb for normal here. In all markets, some sellers overprice and take a price cut. It's usually about a third of the market, though that varies by location. So for example, Phoenix is normally around 40% take a price cut, where the perpetually tight inventory in the Bay Area means only maybe 20 or 25% normally take a price cut. Nationally, more sellers than normal have had to cut their asking prices. So that should be no surprise. What we're watching for now, though, is if buyers remain reticent for the rest of the year, does that downside stickiness for seller pricing start to become unsticky? So that is, do sellers finally get frustrated with a lack of offers and take the discount to move the property? So we haven't seen any evidence of that really happening yet. And since most homeowners have a ton of equity and amazingly good financing, you can imagine that those sellers have no need to hurry. And that's why we do this data work each week. If sellers finally change their expectations, we'll see it in the data very quickly. Mortgage rates stayed higher for longer than anyone anticipated this year, and maybe we finally turned the corner. If for buyers and sellers, these conditions can change really fast, and they need to hear the data from you so they know how to respond. So you should join us at Altos Research. Go to altosresearch.com, book a free consult with the team, and we will help you know how to talk about the market with your clients and prospects today. There's a link in the description below to join us. Click that and let's get started. Also, register for the webinar on Thursday, August 15th. We'll see you then.